Hello friends, just a month ago, there was a feeling of invincibility and perpetuity in the bull market. Perpetuity means the bull market will continue to run for very, very long periods of time. And yet, a month later, we are now questioning whether the markets are in a sell on rallies mode. In this video, I'm going to talk exactly about that based on the weight of evidence and statistical data that you know me for. Now, what really happened? See, in the last 3 weeks, I have been cautioning you that the bulls are likely to be worried about spiking the 10-year Indian benchmark bond yields on one hand and the USD INR on the other. Then another week, I told you it was rising oil prices that the bulls were worrying about. And last week, I told you that the markets needed to overcome the previous swing highs before you could say that the bull market is beginning. But now, this week, I'm asking you whether you should be selling the rallies, which means if the market comes up, should you start to press shorts? That's precisely what this video is all about. And don't forget to watch the Nifty and the Bank Nifty segment extra carefully because that is where the answers lie. So let's dive right in and start looking at the market roundup window. And that tells us that the decline was again led by the banking sector because the Bank Nifty fell more than the Nifty 50. And this is something that I have been warning you. I put up a very small graphic of the performance of the Nifty versus the Bank Nifty on my free Telegram channel, giving you a 4-week, 12-week and 20-week performance of the Nifty versus the Bank Nifty, and that tells you what's really happening. Over the last 12 weeks, if you were a Bank Nifty buy and hold trader, you have not even recovered your rollover costs. You're in the negative. And putting money into a saving bank account would have been a better option. So the fall was led by the Bank Nifty, and a rising US dollar index, the DXY, was another factor that pressurized the markets. And sure enough, the DXY exerted pressure on natural gas and crude oil. Silver bucked the trend by rising a bit on short covering. And what you are seeing is that the rupee also weakened against the dollar to hit 83 minus levels. It fell below the 83 mark. The Indian 10-year benchmark bond yield. Now, this was another pressure point and also a pressure point for banking stocks, has hit 7.22 after crossing 7.25 intraday. The NSE market capitalization fell, which means the rally for a change, the decline for a change was broad-based. MWPL rose, sure enough, but the rally in the MWPL has slowed down. And watch how all the three indices in the US markets have fallen together. It's not just the US market. If you look at the German market, you look at the French market, you look at the British market, the charts are all appearing to be a little nervous right now. And that tells me that the bullish conviction has come down significantly. Friends, now let's take a look at our in-house statistical indicators. And I start with the MWPL or market-wide position limits, which is a percentage of the limits utilized by traders as a component of the total percentage turnover allowed by SEBI. What you are seeing is MWPL has scaled the 20-period high at 39.27%. This is the highest in the period covered by this chart. Will it hit 40%? There is a good probability of that happening because expiry is still a while away. And what it actually means from a behavioral point of view, remember I specialize in behavioral technical analysis. What it simply means is that both the camps, the bull and the bear camps, are basically expanding their exposure in the market. But logic tells you that only one camp is likely to win and the other camp must surrender their positions. Now, when positions are at a high, surrendering of positions also means very large quantities of outstanding open interest needs to be squared up. that will cause big price moves and higher statistical beta or pure price volatility. So let's be careful out there. MWPL rising to an all-time high may be a good thing, but let's also look at the counter view as well. Now let's take a look at the advanced decline ratio, which is the leading indicator after price itself. It's in a decline for a second week in a row and has now reached 0.64 as compared to 0.93 in the prior week. What it simply means is that for every 100 falling shares, there were only 64 rising shares last week. This is an average of all 4 trading sessions last week. That tells you that intraday traders or one Marshmallow traders lacked the buying conviction and they were basically showing signs of nervousness. Another red flag here. Now let's take a look at the basis. Basis is nothing but the premium or discount enjoyed by the futures as compared to the prevalent spot prices. Both the indices, Nifty and Bank Nifty, has shown a very sharp decline in basis on a week-on-week period here. What you are seeing is the Nifty basis is very close to the zero mark and might just go into inversion. By inversion, I mean the basis could get inverted and go into negative zone. What does that tell you? This has the key to the question whether markets are a sell on rallies. What it very simply means is that if a trader is short selling the Nifty or the Bank Nifty for that matter, when basis is inverted or negative, he is saying even though the future price is lower than the spot price, I am willing to short this because I think the market will fall even further. So even though there's a penalty, a quasi or an indirect penalty by way of price to short sell, he's still going ahead with the shorts. So watch out for basis inversion. If inversion occurs before expiry of this derivative series, you have a problem. That could raise the probability of the market becoming a sell on rallies. So let's be very careful out there. Where do you find basis? I put it up every day on our social media accounts. Friends, I now come to the weekly total turnover in the index and stock futures. These are 3 concurrent series, so it's August, September and October. Do remember, last week was truncated due to a holiday on 15th August, so it's only logical that the turnover falls. Also remember that in a down market, trading enthusiasm goes down and turnover typically falls. Friends, the next indicator I share with you is our in-house exclusive indicator, the impetus, which you've enjoyed for a little over 2 years now and trusted it explicitly. This is not available in the public domain, and what we are seeing is impetus reading for both the indices has gone up. The Nifty 50 impetus has risen slightly more in percentage terms as compared to the Bank Nifty. Why does it matter? Hey, both the indices have logged falls, and rising impetus in falling prices tells you that selling pressure was higher as compared to the buying pressure last week. What it tells you was that there was a greater degree of sale participation. Now, this is leading us to the weight of evidence that the markets could be headed for a sell on rallies. I'm not done yet. We'll discuss that even in the index segments. Friends, the next indicator I discuss with you is the lift weight thrust drag indicator. It is again an exclusive in-house indicator you won't find anywhere in the public domain. You've enjoyed this for 1.5 years now. Now, the Nifty has fallen 0.61% on a week-on-week basis, which means the fall has actually escalated. And where the LWTD is concerned, it has come down fairly sharply from 0.35 to 0.11. What does it tell you? It tells you that short covering at lower levels might be extremely limited. Remember, short covering cushions declines. When bears cover their shorts, they are basically sending out a signal that we don't expect the market to fall too much from here. which is why we are booking profits on our short sells that we've executed at higher levels. Although short selling is not expected to cause a big rally, but it cushions declines. Big rallies are caused by fresh buying. So what it tells you is that next week there is a probability that short covering at lower levels may be limited. Friends, indicators done. I now come to the bond market. Remember, we have been at the forefront of the bond market analysis since years, and we've been analyzing bonds before equities in our weekly reports for years now, because we believe that bond markets are the fountainhead of money supply, and other asset class markets derive their liquidity from the bond market. Look at how the weekly chart of the Indian 10-year benchmark bond yield shows a week-on-week gain, even though there's an inverted hammer candle last week. But net, we still saw gains. What it very simply means is that bond prices fell last week, which is why yields have gone up. Now, when bond prices fall, there's a mark-to-market loss on banking stocks because banks are the biggest holders of bonds due to liquidity ratio statutory compliances, and therefore there's a mark-to-market loss on their portfolios. It also tells you that what I have been telling you since 2021 on my social media accounts, that inflation is likely to be a whole lot higher and for a whole lot longer than what you are being made to believe, and so interest rates will be higher for longer. If you read all the frontline international news publishing houses, whether it's Reuters or Bloomberg or whatever, they are now coming around to my point of view, which I have been telling my online family since 2 years, that at some point in time, the bond markets are now resigning themselves to their fate, that interest rates are likely to stay higher for far longer, and the days of easy and ample supply of money at present levels, what you saw about a year ago, are over for a very, very long periods of time. Now, what it really means for the markets is something I've discussed many a times on our free Telegram channel. This is a social media platform on which I put the most amount of our research output. So do make it a point to subscribe to this channel. It's absolutely free. Now, coming back to the bond yields, should you be laddering? No, I don't think laddering at 7.2% or 7.25% also makes any sense, because in the past you and me have laddered at 7.5 and 7.55 and 7.6 also. We've also gone in for sovereign guaranteed schemes, which are EEE, which are giving you a good deal of alpha or pure profits on sovereign guaranteed investments. So I'm still holding on to my checks. And should you go for gilt funds? Hey, no, I've very clearly told you that it's not yet time to go for gilt funds. Remain assured, whenever it's time, you will be alerted on our Telegram channel first. Friends, I now come to the bank Nifty, which took it on the chin and fell the most. What you are seeing on the daily chart is that the bank Nifty fell on all trading sessions and surrendered 0.79% in the bargain. Last week, I indicated to you that there was a head and shoulder pattern on the bank Nifty, and the head and shoulder pattern is a fairly predictable, fairly accurate, fairly accurate and predictive price pattern, and it has bearish implications in this case. Note how the price is staying below the red color neckline of the head and shoulder pattern, and the price is also staying below the month-long moving average, which itself has turned downwards. And the price has stayed below the month-long moving average for the 12th session in a row. That's telling you that buy and hold traders, recent buy and hold traders who've just entered the bank Nifty a couple of weeks ago are clearly in a mark-to-market loss. The 44,152 level that I had indicated as immediate swing support is also violated. So the absolute near-term outlook is nervous. Any rally to the neckline of the head and shoulder pattern, which is approximately 44,500 level, might see some amount of selling. So is there selling pressure likely on advances in the Bank Nifty? Yes, I think it could. Now, unless the Bank Nifty starts trading above the 25-day exponential moving average, I think the outlook remains weak. So the first hurdle is the moving average. Give me the price above the moving average sustainably, closing above it. And I would say maybe the sell on rallies view is changing. Now let's take a look at the weekly chart, which shows the fourth consecutive bearish candle. Last week, I had pointed out in my live mint column that these three consecutive bearish candles are called three black crows in Japanese candlestick parlance. Also in Japan, it is known as Sanba Garasu formation. The last time you saw four consecutive bearish candles on the Bank Nifty was in March 2022. Hey, this is happening after 5 quarters, which is a red flag. And the Sanba Garasu formation, which is bearish in its implication, should follow up selling come, is a fairly reliable indicator of near-term weakness. So is it possible that the Bank Nifty is in a sell on rallies pattern? Yes, I think so, provided you see basis inversion, you see price remaining above its 25-day exponential moving average and 44,152 levels, you are seeing lower tops and lower bottoms formation. On the weekly chart, note how the price is near its 25-week exponential moving average, which is a 6-month holding on cost of an average bull, which means the medium-term players are feeling the heat. If at all this moving average was to be violated, it will happen after 20 consecutive weeks of the price staying above this moving average. And that is telling you that if at all the market is to fall, the fall will be led by the Bank Nifty rather than the Nifty 50. As we compare the Nifty chart ahead, I'll tell you why. In the week before last, this index was number 3 on the most volatile counters list as per statistical beta list that we maintain in-house. Last week, it maintained its position at number 3 itself. Last week, I advocated a range between 45,350 on the upside and 43,050 on the downside, which held perfectly well. In the coming week, I expect a range between 44,950 on the upside and 42,775 on the downside. Friends, I would suggest we trade light because the range might just expand. Especially if the market is falling and the ranges expand, that means the declines are likely to deepen further. So let's be careful out there. And also, remember what I told you in the MWPL segment, volatility will rise because lots of positions need to get cut. Friends, the Bank Nifty done. I now come to the Nifty 50, which fell 0.61%. As you can see on the daily chart on your screen, the price has now fallen below the 25-day exponential moving average, which is a month-long holding on cost of an average bull. The closing is below the average for 5 consecutive days. The average itself is starting to tilt lower. That tells you that weakness in the Nifty is beginning to deepen, but it's not as deep as the Bank Nifty in relative comparison. Last week, I had talked to you about the 19,295 level, which I have marked with a red trend line, which needed to be defended by the bull cam. The price has bounced from there twice in the past, but if the price closes below this level sustainably, then I believe that the Nifty 50 is also entering a sell on rallies phase, and then the bulls will be at a serious disadvantage. Let's now come to the weekly chart of the Nifty 50, which basically tells me that the market the index has fallen for 4 consecutive weeks. Here again, like the Bank Nifty itself, there is a Sanba Garasu or 3 black crows formation. And the last time the 3 black crows formation was seen was in May 2022. That tells you that the fall is rather serious. What you know is from the chart itself as to what happened after May 2022. So 5 quarters ago, what had happened, the Nifty is mirroring that fall again. So yes, it is a red flag. Do remember the basis aspect. The Nifty basis is just 21 rupees now. If it goes into inversion, there is increased weight of evidence that the sell on rallies is gaining momentum. Friends, in the week before last, this index was at number 12. Based on statistical beta list that we maintain in-house, it rose 3 notches to number 9 because volatility went up. Last week, I advocated a range between 19,800 on the upside and 19,050 on the downside, which held perfectly well. In the coming week, I expect a range between 19,675 on the upside and 18,950 on the downside. Did you notice something? The ranges for both the indices are lower as compared to the prior week. Why? Because the markets are sliding. So here again, there is weight of evidence that the markets are looking top heavy. Here again, my friends, I would suggest we trade light because volatility can basically jump significantly. Friends, I now come to the last bit of statistical analysis, which is the retail risk appetite by way of the contribution of the turnover in various segments of the market. Now, the index futures turnover, which is indicated by a blue line on the daily chart on your screen, has gone up by 2 basis points, and stock futures turnover has come down exactly by 2 basis points. So the higher of the two in terms of volatility and margin requirements is stock futures, and there the turnover has come down. That tells you that risk appetite has fallen in the futures segment. What happens to the index, options segment? Index options turnover, which is indicated as an army green line, has fallen, and stock options turnover, which is indicated as a purple line, has risen by a same percentage. So in the option segment, risk appetite has gone up marginally. Net, I would say that traders are treading water, waiting for the next guy to make a move first before throwing their hat into the ring. This can be hardly called the sign of a vibrant bull market when everybody else is waiting for the next guy to act first. So yes, there is nervousness. Now, friends, what would I do? What would be my blueprint in the coming week? I am talking about this since the last couple of weeks, and I've received a lot of positive feedback from you. Thank you very much. Keep it coming. I would bet on theta decay via options segment for the simple reason that I'm not expecting the markets to run away on the upsides in a hurry. I would particularly focus on banks, interest rate sensitives, high debt sectors, and companies that are heavily dependent on EMI-based sales. The reasons I have extrapolated many a times on our free Telegram channel, and that would be your go-to resource for finding out the most amount of data that we put out there. This is a rising interest rate scenario, and anything dependent on interest-based sales, EMI-based sales, is likely to be met with resistance. Rising oil prices may also spook the markets, and I have been telling you why. July to October is the hurricane season in the US, and typically, seasonally speaking, oil prices tend to go up anytime there is news of a hurricane or a tropical storm coming in. And right now, the media is abuzz about Hurricane Hillary. So there is some amount of nervousness, and oil prices are rising in tandem with the news flow. Coming to commodities, base metal prices, industrial metal prices are appearing under pressure. Sorry guys, there is no super cycle here. I've been telling you that since 2021. It's a myth. It's only a bull market triggered by unbacked currency printing. So metal stocks may see an overhang of underlying commodities weakness and higher volatility. I maintain my view that oil and gas are rising on cyclical reasons alone. Add to it man-made shortages of output cuts, and my long-term outlook is weak, especially after the vernal equinox in 2024, which happens to be on 19th of March. Interest rates are finally being acknowledged as higher for longer. This is something that I have been telling you for 2 years now. So I'm not suggesting any gilt fund still, no laddering in bonds either. As I've been warning you since 2021, inflation promises to remain stickier than expected. And I'm posting more and more weight of evidence on distress in Middle East, North Africa, Asia Pacific, Latin America, and Southeast Asia. That blueprint and the implications of that blueprint on commodities, currencies, forex, and bond markets is something that I've discussed a lot of times on my Telegram channel. That remains in place. I'm very happy that there are many tick marks on our checklist of things occurring as we planned or expected them to be. Friends, I now come to the most popular segment on this video, where I discuss 5 stocks that have lost the most amount of statistical impetus on Friday, where you take big exposure, wait for small price moves. These are for scalpers. And 5 stocks that have gained the most amount of impetus, where you take small exposure, wait for large price moves. The list of stocks that have gained the most amount of impetus, where you take small exposure, is led by Muthoot Finance, followed by Escorts, Shree Cements, City Union Bank, and Steel Authority of India Limited. Impetus losers list is led by Godrej Properties, followed by Cummins, BPCL, Tata Communications, and SBI. Friends, this list is valid only for Monday. Tuesday through Friday, I update it only on our Telegram channel, and do subscribe to our free channel and connect with us there. Friends, before I sign off from this video, a reminder to subscribe to our YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comments segment, do let me know how our work is helping you become better traders, and help us reach out to a wider audience by sharing our videos with your friends and family and smart traders like yourselves. Thank you for your patience till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Bye-bye.